Hello and welcome to Markets Today with me, Luqman Hariz, where we discuss market happenings of the day and dissect analysts' opinions on the counters that matter. It is 5:45 p.m. on the 25th of May. The ringgit closed at 4.2985 against the US dollar today. The FBMK LCI closed 2.9 points higher at 1773.96 points. Now, AirAsia X announced its quarterly results recently. Here's some recap for you. The net profit of AirAsia X nosedived 94.2% for the first quarter ended March 31st this year. The long-haul affiliate of AirAsia Berhad registered 10.34 million ringgit net profit for the quarter compared to 179 million ringgit in the first quarter of last year. This comes on the back of higher operating expenses, which includes rising fuel prices. As a whole, AirAsia X's total operating expenses went up 27.6% to 1.12 billion ringgit in the first quarter of FY17 from 879.05 million ringgit a year ago. Out of this total, aircraft fuel expenses alone went up 55.4% to 377.69 million ringgit. This had offset the carrier's stronger revenue for the quarter, which increased 21.6% to 1.18 billion ringgit. The stronger quarterly revenue was contributed by strong passenger numbers, which grew by 33% year-on-year. Well, AirAsia X has been doing well in terms of the revenue, went up about 22% overall year-on-year. They managed to increase revenue across almost all key segments. Revenue from passenger fare went up 27.5%, as you can see. Ancillary revenue went up 34%. Revenue from their freight and cargo business also increased 5.9%, and leasing income went up 16.7%. The only contraction seen here is their revenue from charter flights, which went down 31.9%. And besides passenger fare, they've also seen increases in passenger volumes and margins. Despite a 28.4% increase in seat capacity to about 1.66 million for this quarter, they managed to sustain an increase in pax carried, 32.9%. That's about 1.4 million people carried in the quarter. Seat load factor managed to eke out a thin margin of less than 3% growth. But it's at the cost level that they ache. AirAsia X saw rising costs in the first quarter. Their overall operational costs went up more than 30% year-on-year, subsequently dragging down with it EBITDA and all profits from pre-tax to net to core net, and it is quite significant. Pre-tax profit went down 85%, net profit contracted 94%, and core net profit decreased 71%. Now, cost for fuel went up 55.4% due to the rise in jet fuel. Staff costs for the carrier increased 40.3%. This is because salary hikes for pilots and also crew members as a defensive retention move. Maintenance and other costs edged up 6.6%, and other operating costs ballooned 107%. This would be things like the 6% appreciation of the US dollar, which impacted around 60% of Malaysia AirAsia X's costs. And if you are to zoom in further into those fuel costs, you could see that net jet fuel prices went up 15% in the first quarter, and that 6% US dollar appreciation I said just now pushed up the cost of fuel in USD terms 46.5%, while in ringgit terms it saw a 55% increase in fuel costs. But going forward, AirAsia X remains confident that this are all but bumps on the road. In a statement, it says of its outlook, barring any unforeseen circumstances, including but not limited to terrorist attacks, natural disasters, epidemics, economic downturn, fuel price hike, and fluctuations in foreign currencies against the ringgit, the airline expects its prospect to remain positive. I'm not entirely confident. I think the results of the first quarter is reflective of what will happen in the entire FY17 going forward. One, I'm not confident that the cost of jet fuel prices will go down, but with OPEC considering to extend its production cut for another 6 to 9 months, and we'll talk about that later. If anything, I could only foresee upward pressure on jet fuel prices. And I also expect staff costs would go up for AirAsia X as they did in the first quarter. And according to CIMB research, AirAsia X Malaysia may have to bear startup losses on its new 4 times weekly Osaka-Honolulu route starting the second half of this year. Competition may also heighten in FY17 as rival Malindo, or soon to be known as Batik Air, and also MAB, are expecting to get their new A330s soon, whether by sale or by lease. All that, plus the potential that the USD will again climb, makes me think that AirAsia X's financials will continue to be pressured at least until the end of this year, FY17. CIMB Research seems to agree as well. They maintain a reduced call on the counter, and so does MIDF Research, who downgraded the counter to neutral. It'll be interesting to see what Tony and Co has in store to make sure they maintain significant growth in FY17. We'll take a breather. OPEC meets in Vienna today. When Markets Today comes back, we discuss what to expect from the meeting. Don't go anywhere.